Gold has just done something that almost nobody was emotionally prepared for. On the weekly chart, gold has officially closed above $5,000 per ounce. Not just an intraday spike, not just a headline number, a weekly close. That matters. Weekly closes filter out noise. They remove panic. They remove hype. What remains is structure. And structure is what defines bull markets. But here is the real question. When gold starts printing weekly all-time highs again and again, are we near the end? Or are we entering the most explosive phase? Welcome to Gold Silver Scope. Today we are not reacting emotionally. We are not chasing headlines. We are going to study historical data, compare it to the current cycle, and ask one powerful question. If history rhymes, how much higher can this bull market really go? First, let us understand something very important. All-time highs do not happen randomly. They come in clusters. When gold breaks into new high territory, it does not just touch it once and disappear. It often stays there. It builds momentum there. It creates what we can call a high-density, all-time high regime. If we look back at the great bull market of the 1970s, especially the powerful move that ended in 1980, we notice something fascinating. Around 34% of the weeks during that cycle were new all-time high weekly closes. Think about that. 1 out of every 3 weeks was a new record. That is not normal price action. That is acceleration. Now compare that to the current bull market, which began in 1999. The data shows that about 39% of weeks during this cycle have closed at new all-time highs. That is even higher than the 1970s concentration. That tells us something very powerful. This bull market is not weaker. It is structurally stronger in terms of record frequency. Another key observation is volatility. Recently, gold has shown extreme intra-week swings. We have seen drops toward $4,400 and spikes toward $5,500 or even $5,600 within short periods. That kind of volatility often makes investors nervous. But what matters more than volatility is where the market settles. And it settled above $5,000 on a weekly basis. That is strength. Now let us look at drawdowns. In the 1970s bull market, there were deep corrections. At one point, gold fell roughly 45% in the middle of the cycle. And after the final top in 1980, gold eventually fell around 70% over the next 2 decades. Those were brutal moves. But what is interesting is what happens near the end of bull markets. The corrections become smaller, the pullbacks become shorter, the market stops giving big discounts. And in the last few years, we have not seen major 20% drawdowns from weekly all-time highs except briefly around 2022. Recently, gold has been hugging its highs. That is not weakness. That is late-stage momentum behavior. This clustering effect tells us something important. When gold enters a high-density all-time high regime, it tends to stay there for a while. It becomes normal to see new highs. Investors become conditioned to strength. Momentum traders join. Institutions allocate more capital. The narrative shifts from, "Is gold breaking out?" to, "How high can gold go?" But here is where it gets even more interesting. The current cycle is already much longer than the 1970s cycle. The 1970s bull market lasted roughly a decade. The current bull market has been developing for about 27 years. That makes it more horizontal in time. But could it also become more vertical in price? That is the key question, because if we are already seeing a higher percentage of record weekly closes than the 1970s, and if volatility is increasing while corrections are shrinking, we may not be at the end. We may be entering the final acceleration phase. And historically, the final phase of a gold bull market is not slow. It is not calm. It is explosive. Now, let us go deeper into something very specific and very powerful: consecutive all-time high streaks. It is one thing for gold to make new highs occasionally. It is something completely different when it makes new, weekly, all-time highs week after week without stopping. That is not normal market behavior. That is momentum building on momentum. In the 1970s bull market, the longest streak of consecutive weekly all-time highs was 7 weeks. That happened between September and October of 1978. For 7 straight weeks, gold closed at a new weekly record. Imagine the psychology during that time. Every week investors opened their charts and saw a new high. That creates confidence. It creates urgency. It creates fear of missing out. Now here is where things get very interesting. In the current bull market, the longest consecutive weekly all-time high streak is 8 weeks. That happened recently between August and October of last year. 8 weeks in a row of new weekly record closes. That is a historical record for gold. It had never done that before. So what does that tell us? It tells us that this cycle is not weaker than the 1970s cycle. In terms of streak intensity, it is actually stronger. We are seeing longer record-breaking runs. That suggests stronger momentum, stronger capital flows, and possibly a more aggressive final phase. But there is another way to analyze this. Instead of looking only at consecutive streaks, we can also measure how many all-time highs occurred within a rolling 6-month period and within a 1-year period. This gives us a density measurement. It tells us how saturated the market is with record closes. At the end of the 1970s bull market, during its final year, gold produced about 26 weekly all-time highs within a 52-week period. That means half of the year was spent closing at record highs. That is extraordinary. That is not a normal uptrend. That is a mania phase. Now let us compare that to where we are today. Currently, gold has produced 24 weekly all-time highs within the last year. That is extremely close to the 26-week record set during the final stretch of the 1970s bull market. In just a couple of weeks, we could match that level. If the trend continues, we could even exceed it. So naturally, the question becomes, are we already at the same stage as the 1979-1980 peak? Are we at the edge of the cliff? The honest answer is we cannot say for sure. But data suggests something important. In the 1970s, the longest streak of consecutive highs did not mark the end of the bull market. It did not signal the top. It happened well before the final blow-off move. After that 7-week record streak ended in October 1978, gold did not collapse. It did not enter a bear market. Instead, it continued rising for another 65 weeks. And during those 65 weeks, the most explosive move happened. This is critical to understand. The longest streak did not end the cycle. It marked the beginning of the most vertical phase. So if we apply that same pattern today, and we take the 8-week record streak that ended last October, and we extend forward by 65 weeks, that projection would bring us into early 2027. Does this guarantee that the bull market will end in 2027? No. Markets are not mechanical copies of the past, but historical symmetry often gives us timing windows. And according to that symmetry, we may still have one final year of aggressive upside. Now let us think about the psychology of late-stage bull markets. Early in a cycle, investors are skeptical. Mid-cycle, they become confident. Late cycle, they become convinced that price can only go higher. That is when vertical moves happen. That is when price accelerates far beyond what traditional models predict. Another important factor is volatility compression before expansion. Recently, even though gold has shown sharp intra-week swings, the weekly structure remains strong. We are not seeing deep 30% or 40% corrections. Instead, dips are being bought quickly. That kind of behavior is common in late-stage momentum runs. If we combine all of this data, higher density of record weeks than the 1970s, longer consecutive streaks than the 1970s, and a similar count of record highs within a 52-week window. The conclusion is clear. We are not in a weak bull market. We are in one of the strongest structural bull markets gold has ever seen. And if history is even partially repeating, the most dramatic price expansion may not be behind us. It may be directly ahead. Now we come to the most important part of this entire analysis. What actually happened during the final 65 weeks of the 1970s bull market? After the 7-week record streak ended in October 1978, gold did not slow down. It accelerated. In those final 65 weeks, gold rose approximately 3.5 times in value. That is more than a 250% gain in just over 1 year. Let that sink in. Gold moved from around $234 to $835 on a weekly closing basis. And that $835 was not even the intraday peak. The intraday high went even higher. But even if we only look at weekly closes, the move was explosive. That is the nature of late-stage bull markets. The biggest gains often happen at the end, not at the beginning, not in the middle, at the end. Now let us carefully apply the same framework to the current cycle. The longest consecutive weekly all-time high streak in this cycle ended around October, with gold closing near $4,250 at that time. If we take the same 3.5x expansion that happened in the final 65 weeks of the 1970s bull market and apply it to $4,250, we arrive at a number close to $15,000 per ounce. And if we extend 65 weeks forward from last October, that projection lands around January 2027. Now pause for a moment. Does this mean gold will definitely reach $15,000 by 2027? No. Markets are influenced by liquidity, global policy, interest rates, geopolitics, and investor psychology. No single historical comparison guarantees the future. But what this tells us is that a triple from current levels is not mathematically impossible. It has happened before in a similar structural setup. The data shows precedent. When people hear $15,000 gold, it sounds extreme. It sounds unrealistic. But so did $800 gold in the 1970s when it was trading near $200. Extreme moves feel unrealistic before they happen. That is why late-stage bull markets catch most people off guard. Another important point is timing psychology. Many investors hesitate to enter late in a bull market because they fear they are too late. But historically, the steepest gains often happen in the final stretch. If this cycle is following a similar path, the coming year could be the most aggressive phase of the entire 27-year trend. However, late-stage bull markets are also volatile. Price swings become wider, emotions become stronger, headlines become louder. That is why risk management becomes even more important during this phase. So where does that leave us? We have 3 major takeaways. First, we are in a high-density, all-time high regime. Record weekly closes are happening more frequently than they did in the 1970s. Second, consecutive all-time high streaks are longer than ever before, showing strong structural momentum. Third, historically, record streaks did not mark the top. They preceded the most explosive phase. If history even partially rhymes, gold could be entering its final acceleration window. And if the 3.5x pattern repeats, $15,000 by early 2027 becomes a data-based projection, not just a fantasy number. But remember, projections are probabilities, not promises. If you found this deep analysis helpful and you want more data-driven breakdowns on gold and silver markets, make sure you stay connected with Gold Silver Scope. This channel is dedicated to clear, simple, and powerful analysis without hype and without emotional bias. And finally, a short disclaimer. This content is for educational and informational purposes only. It is not financial advice. Markets involve risk, and you should always do your own research or consult a qualified financial professional before making investment decisions.